Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks drag Wall Street's biggest rally in more than 2 weeks. Sentiment boosted by a rebound in U.S. consumer confidence and easing trade tensions. But does this really signal a switch away from Sell America theme? We'll ask Federated Amir's portfolio manager, Manna. Also ahead, hear why a big Malaysian bank says global rebalancing away from U.S. assets is set to prove a boon for emerging market assets.
Even some changes on the periphery, some unwinding on the periphery, it doesn't need to be large, it may not be large. That money needs to go somewhere. That money, in my view, will go to the emerging markets, and I'm positive that ASEAN and Malaysia will capture a part of that liquidity.
Indian markets may also be an option for investors selling out of U.S. We'll discuss that exclusively with UBS live from their Asian Investment Conference. Welcome to Insight. Sentiment on the markets boosted by a rebound in U.S. consumer confidence and a global surge in bonds. The rebound broke a Sell America trend in the markets that was most visible in the dollar after President Trump unleashed his tariff war and pushed for tax cuts. So can the momentum on the markets be maintained? Well, we have two catalysts ahead. Investors are awaiting Nvidia earnings, and a beat on the lofty expectations could fuel a rally on tech shares. And today, investors are focused on the Japanese bond market as well, which is set for an auction of 40-year JGBs. Global bond investors face the risk of fresh volatility if the offering sees poor demand. The sale is a key test for longer maturity bonds amid concern from Tokyo to New York that rising government spending will take budget deficits into dangerous territory. Well, joining us now, Manna, portfolio manager at Federated Amir's, which manages assets of around $830 billion. Good to have you with us, Karen. What's your take on it? How much is at stake when it comes to this 40-year JGB auction?
I think it's a really important tell for the markets, not just how the auction goes, but how the governments begin to respond with their issuance.
What are you anticipating? Because some say that unless we get a strong demand for it, then you can expect fresh volatility in the bond market globally.
Definitely. I think, again, it's a very important tell for the market, and we're going to have to see if the demand steps up for what we know will be ensuing supply. So it's a very important and critical moment for the market to see what happens here with this auction today. And very interesting that we're all watching these auctions, I think, with renewed interest and vigor.
But this is a highly manipulated market, right? I mean, we know that the BOJ owns more than 50% of all JGBs out there. Is it a fair assessment of risk and reward? Is this the market to be basing it on?
Well, at least it's a start, right? It's an indicator as to where investors are willing to go and how steep of a curve they would like to see. So it will be interesting for all of markets to see how this one plays out. But you're right, there are forces there that have perhaps more weight than others as we settle these auctions.
It is a higher yield environment, including that in Japan. I'm just wondering how attractive longer dated bonds are to you right now. How are they looking?
The yields are definitely attractive, but to investors in the bond markets, we're definitely looking at where they will continue to go. Timing is everything. And we also want to see where inflation is going. We're in a different environment with inflation here that is persistent, and to use an overused word, somewhat sticky. It's a far different construct than we dealt with for the past or prior, I should say, 10-year period when inflation was low. So while the yields are attractive, I think investors are really wrestling with that conundrum of where does inflation go? Does it continue to be sticky, or dare I say, even begin to persist higher based on fiscal policy and tariffs, based on global trade movements and preferences globally? And then how do we contend with rising yields and demand for term premium? Do the longer term yields continue to push higher?
Isn't it true, though, that yields are trending higher from here, whether it is in Japan or in the US? The trend is on the upside.
Likely, but as always, it depends on your time period of measurement. We view things as being uncertain and tensions on either side. At times, we see valuations as attractive, and we may move our actively managed duration of our fixed income portfolios, accounts, and funds long. Or we could see a situation where we think that yields could persist and push higher, and we may move slightly shorter. But by and large, at this very moment, it seems that there are enough forces that could send yields slightly higher, and then those that could take yields down. For example, we've had a tumultuous, is that fair to say, April and May, and yields have now climbed again. So could they be poised to roll over slightly at any slight positive news, like today's consumer confidence index? Is that enough? Or is the notion that ensuing supply, perhaps a budget reconciliation package that continues current spending without enough fiscal responsibility for any of the hawks that are out there, then it could go higher.
What are you positioning for, Karen?
I'm walking the line on duration, to be honest. I'm not willing to make significant calls on duration, and that may not be the exciting choice right now. But by and large, I do think that term premiums, or that's the measure between Fed funds rate and the 10-year, will continue to push wider and steeper. So that does make me concerned about the long end of the curve. So for investors that are seeking a position with newer dollars, right, whether they have new cash to put into their investment portfolio, or if they're harvesting gains out of equities, wherever they were, I suggest moving into shorter duration assets. Those are focused on the 1 to 3 year maturity part of the curve, and then really balancing out your liquidity needs, evaluating what liquidity that you need, utilizing money market funds very effectively, and then seeking investments in the 1 to 3 part of the curve. So you can tell my natural inclination is, while I see somewhat balanced risks on 10s and 30s, I do think that we have enough pressures over the long run that rates could push higher. And that, by and large, is within that inflation construct.
Karen, when it comes to the U.S. economy, the big concern is debt, $34 trillion. And, you got to wonder whether that's egregious enough to make the dollar unstable. What's your take on that?
It could be a contributing factor. I think oftentimes when we see these movements, there's more than one force at work. Definitely the deficits are on the rise, and they're captivating the headlines and the attention right now because we're in the midst of the budget process and as yields move higher. But I think that our stance as a country, with the tariffs and with countries just looking at their own spending and making assessments, I think that we're just having a global shift where we once were dollar dominant, we once were US dominant, and portfolio managers, investors are taking a look at those long or overweight positions and reassessing, perhaps going to neutral and finding attractive fixed income opportunities elsewhere. I think it is not going to be sudden. I don't think it's going to be a tumultuous shift from here forward. We had a moment in April, right after the tariff announcements on April 2nd, where we saw a sudden shift. But I think now we're sort of in a slow grind as uncertainty continues to persist. We're always one headline away from dramatic swings in markets. But overall, I think we have an investing populace that is seeking opportunities outside of the US, but not abandoning. It's not a yes or no, black or white. good or bad situation. I think it's just an appreciation for broader portfolio constructs and reducing longer overweight positions to the U.S.
There's so much uncertainty out there, including the outlook for inflation, whether it is 10, 30% tariffs. The tariffs are inflationary. The question really is whether or not the Fed is able to rein in inflation. And so far, they've proven to be successful. How are you looking at that?
There's definitely a tension here. And I think the market, dare I say, is becoming almost accustomed to the uncertainty. What we're seeing is companies that are holding back. They're not slashing a workforce. They're not cutting investment. They're holding back for now. But as we approach some certainty on inflation policy, as we approach the resolution of the budget, as we approach the resolution of the debt ceiling, we'll have a better construct for companies to make decisions. I think inflation here largely stays higher. I don't know that I see us getting below 2%. I think that those days, just relative to labor force availability, how goods are moving, we've kind of come through the apex of just-in-time inventory and just when supply chains were operating at their apex of true efficiency. Now, countries, companies, and individuals are exploring different ways to obtain goods that I think increases costs overall. I think we also have a structural change in labor, where at one point in time we had far too many people for the number of available jobs, and now we have more jobs than people here in the US. So it's a situation that is broadly changing, overall leaves inflation pressing perhaps not above 3%, but always dancing between that 2.5% to 3% level rather than pushing more toward that average of 2% that the Fed would like. I think the Fed wants to see a trend for sure. So that takes the summer meetings likely largely off the table without a massive event.
So, Karen, what does it all mean for the Sell America theme? Does it persist? Does it not?
I would say it's evaluate America and consider the options. Again, you see, I always pull away from those extremes, right? The extreme tendencies. And I think we all invest in what I call the vast gray middle. We're not always capturing the high and low or the extreme buy and sell. But I think that your intonation is correct. There are attractive options out there now relative to the United States that weren't there for many, many years.
So that would mean what? Emerging markets, Japan, what else can I think of? Perhaps even Europe.
Yes, Europe is attractive at this point in time. And I think, you know, it's a good opportunity for world markets, for investors to have just even more options. And one of the true keys to portfolio management and risk management is diversification. So better options all around for investors.
It is interesting when you take a look at the dollar in particular. Volatility has indeed increased in the last 1 year. The hedging cost is higher. Does that necessarily mean, you know, a greater appreciation for Asian currencies and appreciation of Asian currencies?
It could be. I mean, the dollar was exceptionally strong for so long that I think that this turnaround and deterioration, and then I think just the opportunity to look for value in other currencies is very real. So I think that we have not only the movement of the US dollar, but also the opportunity to look elsewhere and again, achieve what I think is truly an attractive mix of diversification. Many portfolios likely had gotten too weighted to the US dollar, to US treasuries, to US companies. So US exceptionalism, while it reigned for a very long time, I'm not saying that it has completely gone sour, but I think that the world has gained a renewed interest in seeking opportunity outside the US, but while keeping a careful opportunity or eye on what could be available in the US as well.
Karen, thank you so much for your insights today. Karen Manna, Portfolio Manager at Federated Emirs. Now, signs of a Sell America movement in Asia are the focus of our Big Take today. Some $7.5 trillion in investments from the region are at stake as President Trump's efforts to bring manufacturing back to the U.S. upend global supply chains. Subscribers can read that story now on NI Big Take or at Bloomberg.com. Much more ahead. Keep it here with us. This is Bloomberg. Our very own Avril Hong has been covering the summit in Kuala Lumpur. Avril, you spoke to the CEO of one of Malaysia's biggest banks who sees some wins ahead from the Trump-induced distaste for U.S. assets.
That is right, Has. I spoke to the CIMB Group CEO, Novan Amirudin, and of course, CIMB is not just one of Malaysia's largest lenders, it's also one of Southeast Asia's largest lenders. And it's this idea that the Sell America theme being underway is going to prompt the capital looking for new homes, right? And he thinks that Malaysia is well poised to benefit. It's not just about how these structural reforms in the country are well underway. It's also the idea that we're seeing really strong domestic demand amid these uncertainties even. So he thinks that all enhances the appeal of Malaysian assets. Take a listen.
I think we're entering an extremely interesting times. Foreigners hold about 37 trillion US dollars of US assets. And if you think about it in perspective, right, the US population of global population is about 4 or 5%. US equity markets over global equity markets is close to 50%. But US share of financial assets, of global financial assets, is 70 over percent. For 4% population, capturing 50% of equities and more than 75% of financial assets. Of that size, foreigners hold 37 trillion US dollars of US dollar assets. Even some changes on the periphery, some unwinding on the periphery, it doesn't need to be large, it may not be large, but even a 10% change, for example, will see a lot of capital being freed up. In the case of 37 trillion US dollars, if it's 10%, it's 3.7 trillion US dollars being freed up. That money needs to go somewhere. That money, in my view, will go to the emerging markets, and I'm positive that ASEAN and Malaysia will capture a part of that liquidity I mentioned.
You talk about, that capital coming to ASEAN, Malaysia perhaps a beneficiary of this, because in terms of when you look at the lay of the land, maybe foreign outflows compared to other Southeast Asian countries maybe haven't been as bad. The ringgit has been stable as well. Do you think all this is enough for investors to perhaps look at Malaysia and view it as a sort of safe haven?
Well, based on our discussions with foreign investors today, investors are looking for various things. They're looking for political stability. We have that in Malaysia. We have reached that maturity where we're now operating in a coalition government. The government is doing all the right things. Despite maybe, over the last 1 year, you would see some equity outflows, but then we're seeing similar inflows into the local bond market. And inflows into the bond market demonstrates the confidence of investors in the country itself, rather than any specific corporate per se. So we have all the parameters, that in my view tick the boxes for investors as they look at asset allocation and investments. So as a result of that, I do see Malaysia standing out relative to other markets.
Keep in mind, it's not just about Malaysian bonds. Stocks have also looked appealing to foreign investors. You look at global funds. So far this quarter, they've bought $45 million worth of Malaysian stocks. And I think, according to Bloomberg compiled data, among the emerging markets in Southeast Asia is the only one that has seen inflows this quarter as well, Has.
That's right. And the U.S. is a huge market for a lot of countries. Now, China urging ASEAN as well as Gulf states to create a big market.
Yeah. Has, as you know, the Chinese Premier Li Qiang has been in Kuala Lumpur this week as part of the ASEAN GCC China Summit. And you think back to last month when the Chinese president was in Southeast Asia. Remember how he touted this idea of a united Asian family. So this talk about a big market, I think, is the Chinese premier taking things a step further, and how, you know, the ASEAN GCC Chinese regions can build on this big market. He talks about how the regions account for a quarter of the global population, $24 trillion in terms of combined GDP. There's certainly a lot of potential here. And just to give you a sense of how seriously China's been taking all this, we briefly interacted with the NDRC chair as well as the PBOC governor as they were entering the ASEAN-China GCC summit yesterday afternoon. So certainly it gives you a sense of these high-level dialogues that are taking place here. But Li did acknowledge that when it comes to the different phases of growth some of these countries across the regions are seeing, he acknowledged the differences, but he says that this shouldn't stop them.
But it's not just about the governments, the state leaders, right, Avril? I mean, what's the sense among the business community?
I think there is a very optimistic sense of what can be achieved here. I mean, you look at the state leaders here and how they've been discussing trade, investment, supply chain development, and just showing you the front page of a local paper today, the family photo, right, talking about a substantive summit. As you know, the watchers in the business community keep an eye on this. They want to go to see the details of what exactly can be achieved when it comes to development and cooperation. So just citing an example of an area of cooperation, think about Chinese EVs, right? We saw the ex-Peng president Brian Gu on the sidelines of some of these events as the ASEAN Summit is underway this week. And our sources also told us that Geely is also present here in Kuala Lumpur for some of these meetings with other business leaders. Keep in mind, as you know, Has, that Malaysia does have an auto sector, but is also looking to promote electric vehicles, whether it's via manufacturing or production. And the fact that Xi and Li, you know, both being present in Malaysia this year, I think that also really underscores the importance of Malaysia to China. Has.
Avril Hong, great reporting there from the ASEAN Summit in Kuala Lumpur. Let's get back to markets. Take a look at how U.S. futures are trending. Of course, we saw stability in markets just yesterday where stocks rose on Wall Street after posting its biggest rally in more than about 2 weeks. A rebound in U.S. consumer confidence from a 5-year low, also global surge in bonds helping that sentiment. S&P futures currently flat right now, and we're seeing gains for the NASDAQ futures just marginally, though. Treasuries, of course, front and center signs of stability. 30-year yield steady after posting the biggest one-day slide since late March. Still to come, we'll be live at the UBS Asian Investment Conference in Hong Kong, speaking exclusively to the India markets head about the trade outlook. Keep it here with us. This is Bloomberg.
We expect continued volatility. And in that perspective, I think being diversified, thinking in scenarios, that is absolutely key. We do continue to expect that rates will come down. It's a question of time. And of course, as we see further data come out, and also just let's not forget the uncertainty we still have around tariffs and the environment itself. So I do feel that while we will see rates come down, it's a question of timing.
Those kinds of changes in forecast would suggest there are big event risks. And ideally, if you're a business, United did this, if this happens, we will have this kind of outcome. If that happens, we'll have a different kind of outcome. Maybe that's where we need to go right now. Point forecasts are pretty useless.
I think for the government, next step is they probably need to prepare more money to supplement the trading program. At this pace, some of the planned money may be used up by the summer, so they could do more. We are expecting another couple of $100 billion, for example. So in our 4% GDP forecast, we are assuming 0.5% to 1% of GDP of additional fiscal stimulus coming in, and that has been relatively slow, but we think it's really necessary.
Welcome back. You're watching Insight, and those were some of our exclusive guests from the UBS Asian Investment Conference. More coming up live in just a couple of minutes. It's 11:30. That means Japan is back from that lunch break. We are keeping an eye, of course, on the 40-year auction. This is one that is closely watched given the volatility in the JGB market of late. Remember that last week's 20-year note sale got the weakest demand in more than a decade. That had caused ripples across the global bond market. But of course, in recent days, we've seen the yields on Japan's super long bonds extending those declines after a finance ministry official sounded out market participants on the right amount of insurance. It does seem like, there's some comfort in the fact that perhaps Japan is willing to step in and do what is right. Let's take a look where we are in terms of the Nikkei 225, currently up by 0.7%. The topic's also in positive territory. Now, one company that we're keeping an eye on as well is Nissan, currently trading up by about 3% as we speak. It is planning a $7 billion funding with backing from the UK government. Nissan's financial situation is deteriorating, as you know, and some expecting that excess cash to actually dwindle from here. Nissan rising on the back of that scoop from Bloomberg. It is up by about 3%. We're also keeping an eye on the Indian market as we count down to that open. It is opening in about 12 minutes from here. Take a look where we are in terms of the rupee. Currently, it is trading lower by 0.4%. This amidst news from India, the finance ministry saying that the U.S. trade deal holds the key to reducing external risks. It's also the key to boosting exports. It expects an interim deal by July. Whether that happens or not, well, we wait and see. Again, the Indian rupee currently trading down by 0.4%. Now, let's bring in Bloomberg's The China Show co-anchor, David Inglis, who joins us live from the UBS Asian Investment Conference in Hong Kong. Dave.
Yeah, it has. Fantastic timing, I should say. So it was quiet. It's getting loud right now. You might see more volume of people. I'm calling this a white-collar mosh pit as one of the sessions just ended. So just expect the noise levels to go a little bit higher. But that said, we have a really great conversation coming up right now. We talked about India. You just talked about the open in a couple of minutes there right now. Joining us here on set is the head of global markets for India at UBS, is Gautam Chhaochharia, to talk us through the big themes taking place under your hood right now. It's very nice to see you, by the way.
Thank you, and good to be here.
So the trade and tariffs have dominated, I'm sure, even discussions inside, and it's ironic and I guess fairly encouraging in India's case, one of the first markets to recover, and then some more. The notion that it's an insulated market, is that a good starting point for global investors?
It is, because that gives you a lot of resilience, especially in a globally uncertain environment. And resilience is in a couple of ways. One is trade economics-wise, India is the least vulnerable compared to many economies. And even financial markets, the vulnerability to external capital flows has come down materially given the advent of the local flows coming in. Like last few years, foreigners have largely sold or been net zero inflows into India. But markets have only gone up. Yeah. So resilience is a good starting point, but India has always been a good hope story. It's delivered to some extent, not completely, but that is where the tariff and the trade situation would come in. Look, India is resilient, but this entire tariff discussion and deals, or whatever you call it globally, could actually create opportunities for India.
The minimal downside, is that a good way to describe, in a worst case scenario, and we don't know, by the way, how the trade negotiations will go, minimal downside?
Absolutely. From a trade perspective also, like even the US-India trade, there are various economist estimates that even if US ends up imposing the tariffs in a relative way, not just absolute, the downside is 20 basis point of GDP for India, because the trade itself is small for the size of GDP. But in the upside case, we have deals between US and India. There is a India and Europe deal being talked about. India just signed one with UK. Those can create material upside to a long term. I mean, very early days, but could create material upside.
Looking from the outside in, and I hope you could give us more insight on this, the conversations around the tariff, there was a threat that tariffs would be this level. The U.S. wants zero tariffs. There's conversation around certain phases of what the deal looks like. The tariffs are in place in India in certain sectors for certain reasons. How do investors, global investors, need to be thinking about the potential impact if, in the event, India does bring down some of those levies? Cars, for example, is a very good example of this.
Look, the simple way to think about it, many of the products in the consumer and industrial category, it will not likely hurt India a lot. Like, let's look at passenger cars. India is primarily a small car market. The sale of large vehicles from the BMWs or the Fords is a very small part of the market. Go back to motorcycles, where we keep hearing about the Harley-Davidson anecdote. That's a very small part of the market. So again, India at a macro level, the vulnerability to all that is fairly limited. I would say almost insignificant. Where there is some risk is on the agricultural side, because India is still a largely, especially social political wise, dependent on agriculture locally. And that's where the sensitivities are there in all these trade negotiations. How much will India open up its agricultural market? Because even US wants India to open up its agricultural market.
They want to sell their agricultural goods.
Absolutely, that appeals to their local ecosystem. So that's the sensitive part. But broader industrial and consumer products, I don't think it will matter much. In fact, opening up, and if India gets some benefit out of lower tariffs for India's products in those markets, it's net positive, right?
So the markets rallied, as we've pointed out. What's the mood like? Is it the same as last year, sentiment-wise?
Not yet.
Okay.
But the
that's good. That's good, by the way. In some ways, last year got a bit euphoric.
Yeah, absolutely. Last year was feeling uncomfortable. That to be frank, because euphoria is never good for longer-term market performance. So both sentiment and valuations, it's in a much better place, and I would say there's optimism versus 3 months back, but nowhere near last year. Even optimism, like the best example of that is the local mutual fund industry, which has been the big anchor for Indian markets. They are sitting on record levels of cash, both in absolute amount as well as percentage of their AUM. Record levels. We haven't seen that level of cash. So there is enough dry powder out there to absorb if there are any uncertain or sell downs, but also shows that optimism is there, but not euphoria.
I think you bring up a very good, pocket of insight there, because one of the things that's come up during this period of uncertainty is we've somehow now reverted to home bias, and I think India is really a good example of the tendency for home bias. You mentioned a lot of cash sitting on the sidelines. Is there a sense that goes abroad, or is there a sense that the first option is to redeploy that in the local market?
Look, firstly, given the way the capital controls are in India, the outflow of capital can never be meaningful. There is a limit on how much of that cash can go out in other equity markets. It's a real limit. So it's likely to go locally only. Locally to large caps, small caps, new deals has to be seen, but it will go to local markets.
Advice now. So for foreign investors, local investors looking to participate in the rally, do I buy the index? Are there certain sectors? Do we go to small caps, which have outperformed by double, I believe, in terms of the large cap index comparison?
So look, small caps are even less attractive in risk reward today. They are much more reasonable than a year back. But again, look, one of the things we always talk about India is a much more of a stock pickers market than many other markets. The thematics work, sectoral allocation work, but stock picking always works. And even today, we see a huge opportunity in small caps also. Large caps, there are a lot of opportunities. I'll give you a simple example. Markets are trading near record levels, valuations are high. But if you look at the financial sector, which is one of the most commonly held sectors by global investors, their valuations are nowhere near record, near their peak records. And if markets are pricing in growth optimism, you cannot have growth coming back without credit growth coming back.
Okay, so that's fair.
So from a pricing perspective, there are opportunities, very clear.
What's the outlook for deals? Yields have come down. Yeah. Equity market prices have gone up. That tells me the pipeline might be loosening up as far as...
The pipeline is big.
Okay. So let's start with ECM.
Yeah, so when you talk to investors, corporates, even our banking team, the pipeline is big. Because it took a break for 3-4 months, given where the markets are, or where. But we saw in the last 2-3 weeks itself, we have seen a flurry of activity already. So my sense is if the markets remain stable, the pipeline and the numbers will not be dramatically different from last year in terms of run rate. You will see a lot coming through.
Okay, that's both ECM and DCM? Both. In terms of the, and that takes me into the exchange rate, which has gone fairly stable given what's going on. There's a sense right now that this pocket of opportunity, and inflation is also quite controlled, that the RBI can actually move a lot more than expected.
Yes.
Should we expect rates to be substantially lower in India this time next year?
I would guess so. Look, if you look at the market yield, there's one RBI policy rate and then second is the 10-year market yield. 10-year yield versus the US yield, the gap is the narrowest we have seen.
Yeah.
Decades maybe.
Yeah, sometimes we don't even know who's high yield now.
Exactly. So that's saying a lot. But RBI's stance is very, very accommodative beyond what they say. We have seen it acting on all three fronts. The rates, so we do expect further rate cuts. But more than the rates, it's the transmission. So what RBI does to its liquidity stance, and that has been very accommodative over the last 3 months. That will matter a lot more on the rate transmission. Okay. Because what we have seen in the last 3 months is easing of RBI on the liquidity stance, rate cuts, but the transmission to the real economy, we haven't seen enough till now. And that's what RBI is focused on. And there I think there is room for markets to be surprised.
And you alluded to this, that's an important point. When does credit respond? And is there a reason credit's not responding yet? Because that tends to be a bad thing unless there's some context there.
So it typically, if you look at even other markets globally, right, typically credit cycle lags the economic recovery. The lag is anywhere between 1 to 3 quarters. So our view would be next quarter onwards, we will see a response. You saw over the last 3 years, the credit growth was in double digits and ahead of nominal GDP growth rate. I think we should see that coming back fairly soon again.
Okay. Anything else to watch? Anything we've missed that's important, do you think?
Look, the biggest thing for us to watch is what's happening globally.
Okay.
The Trump part. I think the one thing which we are tracking closely and looking at is not just the India-US trade deal, but that trade deal versus other markets. Like what happens to US-China deal, what happens to US-Vietnam deal. There's also going to be a relative context because there is hope and optimism about India benefiting from that. To what scale, which sectors, that will matter.
Any conversations here that stand out to you so far? I know you're here for the week.
So again, two things that I'll say till now. It's just early days. We have had corporates yesterday also. One is Dr. Rajan in the morning. Even they mentioned that from the tariff discussion globally, it's an opportunity for India, I think, which is fairly consistent. But again, this shows the optimism. Right. Secondly, we had a consumption panel on India consumers just a while back. Okay. And again, it's very interesting because consumption has been a big bit of a drag. But there were very interesting anecdotes suggesting that it's going to pick up in the next 6 months, which is optimistic, and that's one of our big calls, that this year is about consumption in India markets.
Forgot to ask you about supply chains and the overall expectation that India absorbs some of the global capacity. To what extent do you think we should be thinking about that? Where do you think we'll see that? Are there companies that you guys are talking to already?
That's happening in a big way in our view. Again, what's showing on the ground is you hear about Apple, but the first stage of supply chain is always the assembly part and then the ecosystem develops. So it's happening. It's happening across the electronic and mobile phones, but also beyond that into defense, industrial complex, EVs and so on. Very early days, but the conversations we have or we hear from corporates and policymakers, interesting. The activity level is very, very high. I think it's going to take a year or two before it becomes concrete and showing up in macro numbers, but we are very optimistic about it.
I mean, these are big ticket investments, so it will take some time. Fantastic. Thank you so much for spending the time with us. I think we talked about everything there. That was Gautam Chhaochharia there, head of Global Markets India here at UBS. Thank you so much for the time, sir. There's this bond auction, and from the headlines I see here on the 40-year, the demand wasn't as ideal as we were expecting it to be.
That's right, weaker than anticipated. We know that the bid to cover dropped back to 2.21, the weakest since July. And in terms of the yield, David, 3.135%, that is above the poll estimate of 3.085%. It does seem like there is disappointment. We might see just maybe perhaps a little bit of unraveling in the bond market, yeah?
Yeah, that's a very good point to bring up, and I think we even have to go back a couple of years when the BOJ and conversations around shrinking its balance sheet and it's stepping back from being really the biggest buyer of JGBs. We had concerns back then over who would step into the BOJ shoes if and when the time came that the markets needed that incremental buyer. And you know what? That's to your point. That's the story that separates Japan. On top of what we're seeing globally of this, you could make the argument the structural bear market on long-dated debt, and in Japan's case, who is that incremental buyer now that the BOJ has some increasingly left this void in terms of demand for the bond markets there, even at these yields. I think to your point, it was decent yield, but bid to cover was at a level we haven't really seen. We're not used to, let's put it that way, Has.
Pretty interesting that the world is actually looking at the JGB market. We know that this is a market that's actually dominated by the BOJ itself, right? I mean, it owns more than 50% of all JGBs out there, and yet we're looking at that market to look at risk and reward. You got to wonder how accurate it is, how accurate a market it is, really.
Right. Yeah, the concerns around the liquidity in the market, I think that's a very, very good point to bring up. It's certainly something very, very unique about the Japanese case as the BOJ does step back. I think a couple of days back, Bloomberg did run a fantastic story, in fact, just tracking and charting the illiquidity that we're seeing in some parts of the JGB market. Yeah, I think it's something that we'll definitely need to watch. And I think the point that the two other things before I go is the comments from the Ministry, I think the Ministry of Finance yesterday, they had to, I guess, in some ways step in and guide in terms of supply to be able to maybe provide some decent floor going into this auction today that took that level of, let's call it some form of intervention, and yet here's where we are as far as that's concerned. And the other point too, in the market statements coming out, that if inflation and all these things start to move up, then, it's rate hikes, again, out of the BOJ.
That's right. And the messaging from Japan is crucial, that maybe the long end is important, that they're willing to take steps to address that. David, thank you so much for that. David Inglis, out of that forum in Hong Kong. Thank you so much for that. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Nvidia's earnings are the market's next big test, giving a signal on how AI revolution is translating into profits for the biggest player in the sector. However, some analysts expect President Trump's efforts to hamper China's chip and AI industries may weigh on the company's growth. For more, let's get to our tech reporter, Annabelle Drulis. And Belle, what are we expecting?
Yeah, this is going to be a really very closely tracked earnings report from Nvidia. Of course, always something that's a big market-moving event for us. We had some interesting trading activity on the session on Tuesday on Wall Street. We actually saw Nvidia rising into these numbers, but that also plays into the broader sentiment we had for the S&P 500, where we saw stocks climbing 2%, and that was as the US and Europe sped up the pace of their trade talks. And I think that really speaks to what is the key challenge or the key issue going into Nvidia's for these figures, and that is exactly how they're planning to deal with the issue of not being able to export H20 chips to the mainland Chinese market. But at headline level, the forecast is we're going to see revenue around $43 billion for the first quarter. Earnings per share as well, they're tipped to grow 43% in this period, but that would be the slowest pace going back to April 2023.
Of course, Nvidia, the loss of the Max 7 to release earnings. In terms of the numbers, have the China curbs been fully priced in by the market?
Yeah, this is a really interesting one because we've actually seen analysts trimming their expectations ahead of these figures being released, and we're back now at a period or at a point where we were in October of last year. What's really been the big inflection point for this business, and when analysts started to cut a lot of their expectations, wasn't actually the DeepSeek effect at the beginning of this year. It really was the start of that trade war and the Trump administration as well, as I said, barring Nvidia from selling the H20 chips into China. So yes, that's going to be a big question. I mean, they've already flagged as well it's going to be a $5.5 billion write-down for this period on that. But there are analysts, for instance, over at Morgan Stanley who are saying that the inability to ship that chip to China hasn't been fully appreciated just yet, and there's simply as well no offset to that. China's a market that's been making up around 20% of Nvidia's revenue to date.
As you said, China, a key market. What are their plans then?
Yeah, well, this is something that I asked Jensen Huang about directly when I was in Taipei for Computex, and he was, of course, the big headline for that event. And at that point, he said that they really were still trying to figure it out. Yes, it was a big challenge for them trying to overcome this issue, but they were saying that the chip wouldn't come from the Hopper series because they'd already modified it to as much as they could. There was actually some reporting that came out recently from Reuters, and they're saying that there is a new artificial intelligence chip that's being provided or prepared using the latest Blackwell architecture that's going to be at a lower price point to the H20 model. And so they're saying production of these new GPUs is going to go into effect as early as June. It's expected to cost between $6,500 to $8,000. The current H20 model had been selling for $10,000 to $12,000. But again, that's all Reuters reporting. What we do know is that this does remain a very big challenge for the business moving forward. And it'll be very interesting to see as well what kinds of partnerships Nvidia can strike. We had, of course, the big Middle East move just a couple of weeks back as well. Be interesting to see exactly how the Trump administration manages its relationships with other governments and whether they can find as well bigger markets elsewhere.
So lots of plans for China, Middle East as well, but you got to wonder whether that's all enough to push the stocks higher. We know that they're up about 1,500% over the last 5 years.
Yeah, and I think that, again, goes into sort of the bigger question. But this was a really big talking point at Computex. Really, would there be enough for the business? Have we reached an inflection point? Many people will tell you we're really in the very early innings of AI, and there's a lot more business ahead for Nvidia and other players in the ecosystem.
Right. Annabelle Drillers, thank you so much for that. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.